Hello, and welcome to episode number 7 of Wealth Bites. Today, I really feel grateful because it's the 7th episode of Wealth Bites, and the amount of messages that I get from my community, whether it's on LinkedIn or Facebook or Instagram, to mention how they benefit from this kind of episodes I make and how it's thought-provoking for them is really interesting, and it really keeps me going. So please, if you have any feedback for me, if you have any questions, don't hesitate to reach out. My email is mo@mywealthchoice.com.au, or find me on LinkedIn, Mo Showman, and just drop me a line of whatever you need. Now, back to the episode. So today I want to discuss different ways of building tax smart investments. Tech professionals usually want to have an investment portfolio, whether it's be property or something else, and they want to make it in a tax effective way because they have a high tax bracket, 47% or more, and they are killing it at work, career is progressing, more bonuses, more RSUs, which means more taxes for them. So let me start with having a bit of a explanation of what's going on in your world. So let me guess, you're earning well, you've got a few investment properties, and you're thinking, should I feel more confident about the future by now? Is there anything else that I can do on top of what I'm doing already? Is that all for me? How can I progress forward? So in this video, I'll walk you through the 3 biggest mistakes I see tech professionals make and how to flip them using smart structures and save tax and build real long-term wealth. And this is basically to give you more confidence and more clarity on the future, to eliminate really the question that is going on in your head about, am I doing enough? Am I secure? Am I reaching my goals, etc.? Obviously, I assume here that you have goals that you're working on. If you don't have any goals in mind, drop me a line. I can help you find out and identify your goals if that is something, a little bit blurry for you. So anyways, the first problem is buying assets without a clear outcome. So most of my clients come to me with a shopping list of investments that they have done or they want to do, but there's no strategy. I'm thinking about buying these shares. I'm thinking about buying this property. What's your recommendation there? And there's no strategy. We need to have an end game to understand how are we going to reach this goal. And sometimes they already bought property, ETFs, crypto, and maybe even some RSUs that they haven't sold yet and have been accumulating in their account for the last few years. And that's very, very common. And there is no real alignment. There's kind of a mismatch between what they have in terms of assets and resources and what they want to achieve and their taxes, etc. And this often leads to, few poor outcomes like, higher tax drag, stress during market dips because of the concentration risks of those RSUs, and also poor liquidity. So liquidity is important to manage your financials, because remember, what you are doing is really building wealth to reach out to a goal, something meaningful that money can help you achieve. So liquidity is important. Assets obviously are very important, but also we need some kind of liquidity. I want to share quickly a story of one of my clients who I met, I think 3 or 4 months ago. They had $3 million worth of investment properties, all negatively geared, and they thought that they are on track. But when we broke down the numbers for them, it seemed that they are really out of pocket by huge amounts of money, especially with the high interest rate that they were not prepared for, and they really needed help in how can they continue to hold these assets. And this is where we start building a plan based on their position on the day. Should they have planned earlier and have some kind of stress testing and modeling, they would have understood that it's not really necessary to hold that amount of assets with this amount of debt, and they should have thought about it differently. But anyways, we are fixing that now for them. So a bit of a highlight: negative gearing is not a very successful strategy at all times. In my opinion, it's kind of a band-aid, because if you think about the property that you're acquiring today, you're getting some tax deductions from it because of depreciation, etc. But down the track, when you sell the property, because you have to sell the property at some day for some reason, you're attracting capital gains tax. Restructuring your asset ownership is very important before we think about the asset itself. And this is where the strategy comes in. To talk more about the negative gearing, it's basically, for those who doesn't know, negatively geared assets means your investment is losing money now, and you're using that loss to pay less tax on your income tax. And look, it sounds appealing, and some people would present it in a way like, you get having $15,000 loss or a loss on the property, you claim that as a tax deduction, and it feels like a win because you're paying less tax. But long term, it's really dangerous, because you are relying only on capital growth, which isn't guaranteed if you don't pick the right investment property. I have seen a lot of people fail in the selection process of their property, and this is where the professional team will come into play to put the strategy for you. It damages your cash flow. You have other needs. You are building assets, yes, but there's lifestyle, there's, kids education, there's holidays, and you don't want to miss on any of these things. So you want to build wealth while balancing your life. So when you put yourself in a high interest environment with a lot of tax losses, it means that you're impacting your cash flow, and without really proper look into the future and what does this look like for you, you can be in a very negative territory in terms of cash flow. And look, if you're investing in property because you want to invest in property, that's a strategy. Let's work off that and see what are the things that you can do. But you can't be investing for the tax benefit. That's not freedom. You're really actually getting yourself into more debt and not really achieving freedom in any means. So I've seen many people hold poor performing assets because they got a tax benefit, and somehow they find themselves an excuse and how the asset will improve, the market will change, etc. But what started as a bad asset continue to be a bad asset. So make sure that you're picking high quality assets that are contributing to your wealth and making money. And even worse, most of the people who are holding that bad quality assets they don't know where it's all heading. They just, riding the flow and fingers crossed. And this is more of a hope, not a strategy. So I don't really recommend that. Another very common problem with clients before working with me is that, I ask them one question: what's your strategy? What's your financial end game? And I hear, I want to retire early. And I start asking, okay, when, how much do you need, etc. And what does it look like to you? Another very common problem is that there's no vision or end game for the goals. So when I ask my clients, what do you want to achieve and what is it that you want to do in the next 5, 10, and 20 years? And usually the answer that I get is, I want to make more money, or I want to pay less tax. Look, it's good. Yes, I know no one wants to pay a lot of tax. No one wants to lose money. But why do you want to achieve that? For what purpose? Because simply put, if your purpose is to work option at age 55, that is completely different than retiring in a comfortable income of X amount of dollars every year. It's two complete different approaches and two complete set of financial planning, financial planning tools and planning. So you need to think about what is it that you want to achieve and why do you want to achieve it, because this makes all the difference in the financial planning. And this is actually what makes financial planning really interesting, is it's tailored for everyone, goals and circumstances. It's not one off the shelf, configurations or solutions that we pick and say, okay, Mr. Client, this is what you can do. It's actually different for everyone, and it changes. It's very dynamic, and hence the importance of having someone by your side always telling you what are the good moves and what are the bad ones. So look, talking about all these problems, there are solutions that I would like to talk about today. A lot of things that we can identify as opportunities for progress to either help you to fix some of the mistakes you've done in the past, or help you to avoid mistakes in the future, which I think is invaluable, that you learn from others' mistakes and don't repeat them. So let me talk about the first solution. It's basically the structure. So how can you build a tax smart structure for your investments? So there are a lot of things that you can do. If you think about, for example, and this is not advice, you should seek one, but there are other structures that can help you. Instead of investing under your own name, there are investments that can come under a structure which is called an investment bond. And investment bonds are taxed at 30% maximum. Some of them are taxed less than that. And there's no annual reporting if held in investment bonds. So if you think about it, when you have an investment generating, let's say $1,000 of return every year, these $1,000 are not added to your income tax. They are taxed separately at 30%. So if you're taxed at 47%, investment bonds are taxed at 30%. This means there's a 17% tax difference that you could take advantage of. Good thing also, it's very, very good for kids' education and legacy wealth, and giving you some financial breaks if you like. And you could easily, under some circumstances, invest in a capital gains environment using investment bonds. So it's one of the structures that are very important. It can help you save on tax. Again, this is not advice, it's just general guidance about different structures that are available for everyone. Another popular solution is companies. So some people would use companies to hold investments. They are taxed at 25 to 30%. They are very good for sales or business profits. They are very good to invest if you have a high tax rate and you have investment properties getting you income, etc. So instead of having everything under your name, you can have a company. You will be allowed to reinvest profits and delay some taxes if possible. You don't really have to distribute the dividends or the returns every year like trusts. So it can be helpful for some people. Some other group of people would use trusts. It gives you flexibility in income distribution. Unfortunately, some of the clients come with the idea that the trust is relevant for them because it's just simply save tax. Actually, not for every client, not for every circumstances. It could be different from one client to another. It can give income to the kids, can give income to beneficiaries, but you have to think carefully about how you're going to do that and get professional advice, obviously. Protecting assets through trusts is important to make sure that the assets you are acquiring are not in your own name or your wife's name or your kid's name. You can get them into a different entity name, which gives them asset protection from legal liability, creditors, bad relationships, all this sort of stuff. And it can be, great solution when paired with ownership of property and, managed funds and share portfolio as well. So that's one of the structures that can be helping to resolve this. Another one also, which is very underutilized, which is self-managed super fund. A lot of people are heading towards this direction for a lot of reasons: flexibility, control, ability to access different direct assets that they don't have access to conventionally. You have super control of your goals inside super and how you approach them and achieve them. 15% as income on returns, which is fantastic, instead of 47 outside super, and 0 at pension phase. So even if you are maxed out on your contribution limit, which is the case with most of my tech professional clients, we sometimes put money in super without, this tax benefit of a tax deduction, which is the non-concessional contribution. It actually helps them to build wealth inside super through reduced tax. So instead of paying tax to the ATO, you just save this money and invest in yourself and your fund, which is highly logical, if you ask me. You can buy direct assets like, commercial properties, residential properties, antiques, whatever you like, but just under a specific guidance from ATO you have to follow. SMSF is sort of a complex solution which needs professional guidance. It's not really draining your time or you're gonna, working on it every day. No, you just have to make sure that you have the right team around you. They will support you to make sure that you're able to meet your obligations and, move confidently in the future. Obviously, the last thing that you can use as a structure is your personal name. Most people default to this because they do things as they afford to, but it's the least efficient. If income is over 180K, you're looking at the least efficient kind of structure to use because there's a 47% marginal tax rate, which is very high leakage in comparison to trusts, companies, and all these structures we spoke about, which can provide you with less kind of income tax. So before we wrap up everything, just wanted to go through a quick case study. So it's just a quick story about my client. She was earning $300,000, properties and RSUs are vesting. She felt stuck and paying huge tax and, no freedom inside. She's just, going in, working, paying, and she didn't have really something to show that she's really high income earner, etc. So what we've do is we built a plan for her based on her goals and circumstances. She chose to change her ownership structure of the properties because one of them was very low quality property. So we moved one of them into, she sold one and then bought another one in self-managed super fund. She also established an investment company. She used investment bonds and created trust for spouse and future distributions for the kids because they were somehow eligible. And then the results are amazing. So what she achieved is she saved more than $27,000 in tax in the first year. She had clear timeline about retirement, and that was the most exciting part for her, to understand what the future looks like and the specific milestones that she's going to be going through as we go and progress with the plan. She actually freed up some cash flow after we switched the quality of the property, and what this meant for her is she was able to start her startup. She wanted to do kind of a, I can't remember the name of it, it's kind of a AI agent support software company, something like that, and she was able to put some capital along with a couple of friends and start working on it, and that was like her dream come true. So it's not only about, saving on tax and making money, but also achieve things that are important to you and could make a difference in your life. So if you think about all what we've discussed today, it's all about having things in place through a system, a routine that is followed to be successful. So it's not about just saving tax one-off. It's a consistent saving on tax kind of system. It's one that is tailored to your life, your income, your goals. I know that a lot of people listen to their friends and colleagues in their barbecues and all these sort of conversations that happen, but really this conversation is good for a chit chat, but it's not relevant to you. Make sure that you are eliminating the noise and focusing on your goals and what is relevant to you. And the confident choice system that I use in my Wealth Choice is actually a method that I built for high income tech professionals that is really future focused, tax efficient, and aligned with your real life goals. So it's a system. If you fit in your goals and circumstances into this system, it will give you an outcome that is tailored to your circumstances and allow you to achieve your goal. It's not a cookie cutter system. I have used it with more than 380 clients over the years across Amazon, Microsoft, Oracle, and more. And it's working very well and they love it. So if you're building wealth but unsure where it's heading, I think this is your next move. Have a chat with me. Let's have a talk and see what you're doing and if there are any gaps that you want to bridge and if and how I could help you bridge those gaps. Thank you for listening to me today. I hope you have enjoyed the episode. I hope it was helpful and beneficial and thought-provoking, because that's all what I'm hoping for, to get you thinking about your future and your financial goals. Thank you and see you again. Thank you.